Okay, so we are going to do, so this is class 6, but we're going to spend our time going through the in-class exercise for class 5, and that's in-class exercise 4, right? And that's what we're going to go through as a review mechanism. And so I have the problem in front of me, but I'm not going to show it on the screen just because I'm going to need blank paper to do lots of this. So tell me, for you guys, have you completed the problem and you think you know the answer, or did you get to the problem and you just got stuck? Stuck? Okay. All right, so you don't think you know what the answer is. Okay. All right, so let's, I should say that I don't think I even have the solution in front of me. Do I have the solution in front of me? Probably not, right? No? Okay. So whatever answer we come to is the answer that must be right. All right. So we have our PBT of 1 million. So we're going to do our current calculation first, and we're just one jurisdiction, right? Yeah, that's good. Okay, so we're going to start with our million of PBT and add back our meals and entertainment of 35,000. Book depreciation is 100 and tax is 250, so we have depreciation of 150. The inventory reserve went up by $50,000. So that would be an add back of 50,000. Current year incentive stock option FAS 123R book expense of 50,000. So we'll call that ISO 1. And that book expense is not going to be deductible currently, right? Because we don't get a tax deduction for book expense. Is that a perm or a temp? Majority rules on that. That's a perm, right? Because an ISO, we're not sure we're going to get a deduction. Okay, so then we have ISO 2, right? And with ISO 2, we're getting a deduction of 100, right? And so that deduction is 100,000, but that deduction is really made up of two components. It's a $60,000 deduction related to the amount of book expense that we previously recorded and treated as a bad perm, right, in a prior year. And then it's 40,000 of the so-called excess benefit, right? Okay, we have current year restricted stock unit book expense of 35, so let's call that RSU 1. And is that a perm or a temp? We're going to add that back. That's a temp. Okay, and we have current year RSU tax deductions of 40. We have RSU 2. We get a deduction of 40. Okay, and this one's tricky because this one was really, we had an $85,000 temp item that's going to be flipping, right? Last year we had a DTA, or a deductible difference of 85 that's flipping, and then we have a 45,000 shortfall, right? Because we thought we were going to get an 85 deduction, but we only got 40. All right, so if I sum that up, somebody who has done the math can tell me. 880. Okay. 880. Okay. So 880 times 40%. 352. Okay. So we have credits of 35 from the past and 25 from the current year. So we're going to reduce that and reduce that. So that should be 292. Right? So far so good? Okay.
Question about the ABC credit. Is that something, I thought that was something we should adjust for and then take it as a credit, like take the credit above and reduce your income or so, and then your income, and then take it as a credit later on.
This is just, when you claim an R&D credit, you can either claim a big credit and add some income back to taxable income, or you can just claim a smaller credit and get to the same place. So we're just assuming we have a smaller credit, and we're not doing any of that add back to income stuff.
Is that what
The 280C election to claim, we're electing a reduced credit and not complicate our lives. Okay. All right, so $292,000 is our current tax liability. Right? Okay, so that is our liability balance. Okay? So, from a APIC perspective, we know that this guy, that is our excess benefit. So when you do your provision, you should do your provision with and without excess benefits to find out how much those excess benefits saved you in tax. We only have one excess benefit. It's that $40,000. So if we did this whole calculation again as if that $40,000 didn't exist, this liability would be 16 higher, right? So our APIC is going to go up by 16K on account of the fact that that 292 is lower by 16K with that 40,000 than it would be without that 40,000. Okay? So our journal entry for our current expense is going to be credit liability for 292, credit APIC for 16, and debit current provision for the sum of that. So that's 308. Okay? That's how I would do the current calc. So I know it's like your natural human behavior to try to write all this down, but you can watch this. So I would focus on, do I understand what I just did versus can I write it down? So the confusing thing in here, I suspect, is that I have captured this excess benefit without focusing so much on this shortfall. Right? Okay, and that's because for the moment I'm trying to capture the benefit to APIC I have because of excess benefits. I'll get the shortfalls later. Okay? So if I just do my current calc, I'm going to do it with and without excess benefits, and I'm going to see how much money did I save in tax because of APIC, because of these excess benefits. Alright? You guys can track the solution a little bit to make sure I don't go crazy off course. Yeah, that'd be good. Okay. Yeah? Alright, I feel like you guys are kind of not with me. Alright. Alright, so that was the current provision. Alright, so now I'm going to do the deferred provision. So I'm going to have my beginning of the year deferreds. I will have my change that'll roll through the current. I'm going to have my shortfall. And then I'll have my end of the year. So if I was thinking of deferreds, I would have depreciation. And I suspect that that went from 0 to a taxable temporary difference of 150. Inventory reserve, which went from 0 up by 50. ISOs, are my ISOs going to be in this schedule? No. Right? RSUs, so for my RSU 1, I didn't have anything last year because I just granted it this year. And I have 35 of book expense that I added back. And so at the end of the year, that's me saying, I sure hope when this thing vests, I get a 35 deduction. Okay, RSU 2, I'd say, well, this one's tricky because I started the year with 85 of deductible temporary differences. I only got a $40 deduction, but I have to write the rest of it off so that I end the year with 0. Right? Okay, so that subtotal is 85 and 105. So that's going to be 32 and 234. And I had credits from last year of 35, 69, so that's my R&D credit. Okay. So that's going to be 42. And I used my 35. So that is 77. Okay, so if I did that math right, okay, so that's how my deferred roll forward ought to look. Why are we writing off the 45? Because last year we thought that this 85 was, we were going to expect a future tax deduction of 85 because that's what books expensed. The stock went down. So by the time this person vested in the RSU, the stock wasn't worth 85. They only got 40, so we only get a deduction of 40. So we expensed 85 thinking that's fair value, but the deduction turned out to be less than that because the deduction happens when the RSU vests. And the stock price will always be different than it was when it was granted. So we get rid of the extra 45 because we have to, right? This RSU is gone, so that 45 can't remain there as an expected future deduction because there's no event that will ever create that deduction. The RSU is vested, it's done. So this is simply a reconciliation between what we assumed would be the book, what we assumed would be the future tax deduction based on book expense and what actually became the tax deduction. Okay? Same treatment as non-quals. Yep.
A question about the credit R&D credit. You have the credit carryover. I can see how that's the DTTA being used down there in the deferred. The 25,000 is not going to be used then in the deferred because of this deferred.
We use it currently, so it doesn't need to go through the deferreds. Right. Okay, so if I'm doing a journal entry for this guy, Now, I'm going to show it. I'm sure it'll be different than the solution because I can't remember what the solution looks like, and I suspect if I did this 3 times in a row, it'd look different every time. Okay, so I'm going to show it as if each column, because remember, this right here, that's a balance. This here, balance. I need to explain how I get from balance to balance. So if I thought of each of these columns as something that's going to create a journal entry, then I can say, well, the 77, I need to credit my DTA, DTL, 77. What's going on with the pen? Debit, deferred provision, 77. Simple, right? So that is the entry that pops off of that column's activity. All right? Now this one is a little trickier. I know that I got to get rid of 18 of deferreds. So now the question is, what do I debit? Right? The assumption was that I had no APIC pool to start the year. So I had 16 of APIC credits on my current calc, which means I can debit APIC for 16 here. I can say, well, that shortfall, I'm writing off that excess DTA back to APIC to the extent I've credited APIC. Which means that I would have to debit my provision for 2. Because I'm out of APIC pool, right? But I still got to write off my deferred. So I would think of those 2 entries as my entries to record the movement to get from my beginning balance of a DTA to an ending balance. So remember, like in the first class, and we were showing that matrix of the tax account roll forward, and I showed you every line has to balance, but you're moving from like a balance as of day 1 to the balance at the end of the year. That's all that is. There's just a lot of things in those entries, right? So if you got confused, you could do this for every single fact. You could do it separately. We're just doing it bundled. Okay? Okay, so my current provision, oh my gosh, I can't see that. What was my current provision? 308, that sounds right. Whatever we had two pages ago. 308. And then my deferred provision was 79.
Did you just debit the current provision by 2?
I debited the deferred provision by 2 to say that I had a deferred that I had to get rid of, and I had to write it off through the P&L. But I care less about you deciphering whether it's current or deferred provision than just that it's provision. That's the more important thing. Okay, so that is 387. Is that the answer? Yeah. Hey, yay. Okay. So then let's do a rate rec. Yeah? Okay. So if we were doing a rate rec, we would start with our million of PBT. Okay, so then we would expect that to be 400,000, and yet we got to 387. So we know that meals and entertainment was part of the problem. So that is 1214. We know that the current year ISO 1, so we'll call that meals and entertainment. ISO 1, which was our current year expense of 50. That's not helpful by 40% of that. ISO 2, we got a $60,000 deduction that was a good perm, a non-excess benefit deduction. Right, so that 60,000 is reducing our provision, whereas the other 40, that excess, is not. So the good perm in my provision is the non-excess benefit component of options. My good perm is the lesser of 60 or whatever the deduction was. Okay, well, if that foots, then we're in business. Does that foot? If you can do that, you're going to have no problem with the exam. Okay, what of that do you want me to review again? Or do you want me just to keep going to year 2?
It's 385.
Oh, yeah, duh. Yeah, I have a shortfall. You guys tricked me. You told me it footed. I'm going to have to check on you. Right, I have a shortfall, right? Because I wrote off a DTA that permanently increased my provision. So I have a shortfall. Yeah, anytime you have a shortfall that doesn't go to APIC pool, it'll hit your rate rack. Yeah, so as you can tell, one of the steps you should take when you're doing the exam is to foot your rate rack to make sure it foots. Yeah, so then that works, right? Yeah, 387.
You're going to provide solutions to this, aren't you?
We already sent solutions, I think, yeah? Or we will. We haven't sent it, but we will. So the key here is to calculate your liability with everything in to get the credit to your balance sheet. Okay, that's the first thing you should do. The second thing you should do is isolate just the excess benefits and figure out how much of your current payable changed because just excess benefits existed. Just excess benefits, not shortfalls. That will be your credit to APIC because it will save you tax on account of having excess benefits. Okay? So the yellow is really what people would refer to as your with calc, and your blue would be the incremental effect if you were to do it without those excess benefits. Okay? Alex?
For the rate, could you explain how you got for ISO 260 instead of 100?
Yeah, let me just keep, at some point in this class, probably like the last class of the semester, I'll learn how to turn that off. The 60, remember this 60 right here, if you were thinking of a journal entry for that 60, right, I know this is embedded in this entry, but if you were trying to isolate on that 60's journal entry, that 60 allows you to reduce your payable and credit your provision. Whereas this 40 allows you to reduce your payable, but you credit APIC. Yeah? So, when you book this, that is a provision credit. That is a perm item. That's a good perm. You permanently reduce your provision by the $60,000 that you permanently increased last year's provision by because you got a deduction this year. So last year's $60,000 bad perm turned into a $60,000 good perm. And if it's perm, it hits the rate rec. The 40 is just different. That's hitting APIC because that's excess.
So, like using the RSUs example, so say the RSU numbers, the 35 and the 40, were the actual ISOs, and that's the perm one. Would you be taking for the rate rec? Would you take the 35 or the 40?
Well, the RSU 35 and 40 are two different RSUs. So I think what you're asking is,
if the numbers were back the other way around, is what I'm asking.
right, so I think what you're asking is, like, take RSU 2. Okay, this page is getting to be like a sensation overload. So say that it was this one where you thought it was going to be an 85, like last year you expensed 85, and this year you only got a 40,000 deduction. Okay? So in that situation, all you would have, if this was an ISO, would be debit payable, credit provision for the 40. There would be no excess benefit that goes to APIC. There's not an excess benefit. You didn't exceed 85. So you could only book that entry up to the 40. And that's it. You're done. Okay. So what I would recommend, going back to Linda's questions, was to do the current calc with and without excess benefits. And so from that with and without exercise, you can get the liability entry and the APIC entry and plug expense. Okay. And then when you go to your deferred, I would suggest, and again, I'm sure if you look at the solution it will be presented differently, I would suggest you push through this column things that are hitting your current payable, and you push through this column things that are DTA movement that could be unrelated to the payable, and come up with separate journal entries. I think when you start commingling them, it gets even more confusing than maybe the way I've presented it. Okay? Right, so Lena is saying if you were doing this in Excel, how would it work? And the answer is, like this 150 that is a change in your deferred should link straight to this 150. Right? So they should be pulling between the tabs, because whatever movement you have in your current's got to be the same movement in your deferreds, otherwise you'll be out of balance. And your next question is going to be, well, how does that work when there's movement with these stock comp things where there's multiple elements to it? And the answer is, it's just complicated, but you got to make the Excel sheet work like I have shown the deferred roll forward. And I don't remember if in the Excel sheet I sent you there is a column for shortfalls that would flow a journal entry over to the account rec the way I've shown it. I would be shocked if it was formatted that way, but that's how you would do it. So in theory, you'd go and create a line item in that account roll forward, and you'd create a line item for that entry. You'd say, I'd post this as a journal entry, and I'd post that as a journal entry, and you'd be able to tell the story with each journal entry as to why you're doing what you're doing. Okay? Okay, so I have a view that that is probably good enough, meaning by explaining to you that year 1, you probably could understand year 2. And that maybe we're better off going to our other big problem. But tell me if you think that's... Because I stare at year 2 and it looks pretty similar.
Are we going to be getting, you say we're going to be getting answers on it?
You will get answers to everything.
Okay.
In fact, it's funny you asked that because one of my other partners in San Francisco is going to start teaching a class like this at Golden Gate, and she was asking me for lessons learned, and I told her, if you do not have prepared solutions, there will be like a riot in the streets. And she had not thought of that in the same way I had not thought of that the first time I taught. But yes, there'll be solutions for everything. Okay?
Last question. So with the $45 write-off, what's the accounting entry for that?
What's the accounting entry for the $45 write-up? It's this entry right here. It's the bottom right-hand corner. That's us saying, I'm running out of like ways to color it, but that's us saying we have a deferred asset left after somebody's exercised or vested in their stock comp award. The deduction didn't exhaust our DTA. But if the award's gone, the DTA has to be gone. So we push through the deduction here, the real world deduction. Now we got to get rid of the rest. And getting rid of the rest means we got to credit the deferred. Anytime you have a shortfall where you're dumping deferred assets, you can write it off to APIC if you have a pool.
It's actually 18 bucks because it's the tax. Okay.
And then this is just the excess. And when you're out of pool, but you got to balance your entry to write off those excess deferreds, that's where it goes.
And after that 2000 provision, you will copy also the full provision of the
That 2000 is a deferred provision because it's, you know, deferred provision is the movement in deferreds. And our movement in deferreds is 2 of expense related to a write-off of DTAs that cannot be allocated to APIC. I know, that sounds pretty unhelpful in terms of explanation, but yeah. Okay, what else?
So you say it's due to the written with and without excess benefit. So is that by creating that shortfall column? Is that what you're doing, or I guess I don't get the concept of that.
When people say with and without, they you know, they mean different things. But the way I would do it is I would separate the current calc from your deferreds. Okay, so when you're looking at this table, this page, this is just our current provision. So when we do a current provision, we're going to do it with and without excess benefits. So you could do this calc in 2 completely separate columns. One column that had the full ISO deduction and one that only had a 60,000 ISO deduction. And that tax liability you would get at the bottom, it would be different by 16 grand. And you would know that because of that ISO deduction, you saved 16 grand of tax, and that benefit, that reduction in the liability, should debit payable and credit APIC. That would be a with and without calc. Then you go over your deferreds, and when people say with and without here, it's a little bit different because with and without is more of an excess benefit concept than it is shortfalls. I have shown shortfalls separate from our regular activity just to isolate on the different topics. Some people would blend this, and they would put it all through in one column, and I just find it hard to explain that way, so I think breaking it out is easier. I think if you took every single fact in the problem and you tried to create your own journal entry from it, it might even be a little easier. It just is really time consuming to do it that way. So if you said, look, all I have is ISO 2, what would be my journal entries for that, both for the current and the deferred? If I had RSU 2, what would be my journal entries just for that, as if there was nothing else, right? What would be my journal entries for that? That's another way to potentially look at it.
You have issues though with that, don't you, as far as ordering? Like if you put certain items first, you have to know if you could take the APIC, if you had APIC balance or not.
No question. Yeah, that step-by-step approach might work in the classroom setting. It would never work in real life. Yeah, because as you can imagine, when I say RSU 1 and 2, there might be thousands of RSUs, right? And you really need to see how they're all coming together and what the net effect is. And when, yeah, I mean, if you were to see like Rochelle and Janie's calculation that does this, it's very involved. I mean, there's many inputs.
Yeah. Also, when it comes to these calculations, you know if you have an APIC pool available or not, is it like at a point in time, or is it like at a quarter end, or is it at the year end? Or?
Well, so the question was, when do you stop and measure your APIC pool? And I think what I told you last class was there's two types of companies. There's companies that either have like a big APIC pool, and they just think of it as like so big they're not even worried it's so big. And then there's companies that generally have like no APIC pool. So rarely is a company, I mean, I'm sure it happens, and I've seen it with one of my clients before, but rarely is it a situation where you're like, I just barely have enough APIC pool, I hope I have enough, and then all of a sudden I ran out. I mean, that is unusual. So like NetApp, I'll bet you guys have a huge APIC pool. SanDisk, I don't know. My guess is there's a big APIC pool at SanDisk, and it's like so big no one's even thinking about it. Okay, we good with that problem?
Can
All
I
right.
ask you a question just on the RSU? Is it like Equity Edge keeping track of all this stuff?
Equity Edge does keep track of this. Equity Edge is a software program that will track the setup and reversal of DTAs and how much an excess benefit is, and Equity Edge is probably the most commonly used software program to track this. It's not the only one. And what a lot of companies find that when their tax structure gets complicated and there's stock comp all over the world, Equity Edge really struggles with that. So I mean, that would have been a good question for Elaine, honestly, in terms of how they do it. I don't know. But knowing what I know about the company that's not necessarily public, I would be surprised if Equity Edge can maintain everything that they need.
Would you be able to see the shortfall piece or recognize it in those reports? Is the shortfall or the excess?
Well, so that's a good question. So let's look at, let's pull up their 10K and see what we can find about their APIC entries. Okay. So if I was looking at, so I'm going to start with their tax footnote. Okay. So what they say here is their current provision is small, right? And that provision is the provision before excess benefits, right? Because that's the current expense. So if you were thinking of that in terms of this, that would be the 308 in this example. It wouldn't be the 292. It wouldn't be after excess benefits. It would be before. Okay, the current expense is what's going to flow to the footnote. So they're telling you that even without excess benefits, they don't owe much in tax, right? And the fact that they have a big deferred provision, that means they're crediting DTAs and debiting deferred provision. So without knowing any more than that, you would probably look at that and say, gosh, I'll bet they have NOLs they're using, and they're not paying tax currently, even though they're profitable, because they have NOL carryovers. So they're saying, yes, I'd have an expense, but instead of crediting a tax payable because I owe tax, I'm just going to credit my DTAs for NOLs. I'm just going to kind of use that attribute up. That's what they're saying. And if you looked at this table here, this basically proves it. So they're saying that my tax credits, well, no, that's the opposite. Their tax credits are actually going up. So, well, there's a lot of things happening here. Depreciation is huge, right? They have a big DTL. So, yeah, there's a lot of moving parts here, but what they're basically saying in the grand scheme of things is, I took a ton of depreciation deductions, so instead of paying tax, I save tax because of those depreciation deductions, but that's a temp item and I'll pay tax in the future. So that's saying debit deferred provision and not credit tax payable, but credit DTL. So they're building their DTL as they go from 3 million up to 13. So in effect, they don't care about excess benefits. They're saying, no worries, I'm not paying tax anyways because I'm using my accelerated depreciation. But this is telling you that that's just shifting the problem out to a later day. Okay. And let's see what else they say about APIC. So they say this. Oops. Okay, so they say the benefit of options will only be recorded to equity when cash taxes is reduced. And I just told you they don't have cash taxes because they're using depreciation deductions. So the last thing that they come to is excess benefits. And they're saying, we've got this big NOL, it's 50 million bucks, and all that is APIC related. Because when you look at the NOL up here, they only have a DTA for $2 million. So how can they have an NOL of 50 million related to excess benefits, but only show a DTA for 2? And the reason is they pretend that 50 doesn't exist yet. That's them telling you that footnote 82 thing I talked about last class. That's them saying, I have this big NOL, but I'm not even booking an entry for it. It's like it doesn't even exist. I know, confusing.
Would it even be on there deferred?
Nope.
Huh.
Nope. So what they're saying, so normally you would expect, see if you guys weren't so focused on Lane's career, we would be able to talk about provision or the job she's offering. So normally, if you had an NOL, you would expect debit DTA for NOL, and if it was something attributable to an excess benefit, you would have thought credit APIC. Right? But the FAS 123R rules say, no, don't do that. Don't do anything. So if you have a big NOL, just don't do a thing, which seems very unnatural. What they then say is, if your provision in a year would otherwise be debit provision 1,000, credit payable 1,000. If that's what your provision would be if you didn't have those NOLs, then they say, okay, now you can spring into action. Now you can go look to those NOLs you've been pretending don't exist, and you can reduce this payable. You can debit payable by, 800, or whatever the number is, and you can credit APIC. And that would simply be on account of using an NOL that existed, but you pretended didn't exist before. So this is footnote 82, realization. Okay, so you have to pretend that you're tracking. This is not on the exam, by the way, so you can all just... You have to pretend like you have this NOL that doesn't exist, but you track, and then when you can use it, when you do that with and without calc for the current, and you're like, gosh, if I do my without calc and I have a tax, but I do it again with my options, including all these historic NOLs, and I don't have a tax, boy, that NOL is springing into action. I can use it. So your next question would be, well, how do you track all these things that you have but don't exist on the provision? And that is like a career for some people. That is complicated. We should have asked Elaine that question. How do you track your with and without attributes? Because she would probably have answered like, ha ha ha, that's hard. Okay, so I'm going to take a break, and then we are going to do the new in-class problem, okay?